So again, thank you so much. Ravi.
Great. Thanks, Ryan. For those who are not in the multifamily space, CoStar is one of the key data sources and research sources that we all use to analyze deals and analyze markets. So we're delighted to have Itziar Aguirre from CoStar. She's a senior market analyst for CoStar, specializing in, I guess, the Texas market, Houston. And so we requested that she present to all of us about fundamentals in the Texas market, focusing on multifamily. And just as an aside, she stepped in at the last moment in the last couple of weeks, so we're really grateful. The previous speaker left CoStar, so we were left high and dry. So thank you so much, Itziar, for showing up. She has a graduate degree from the London School of Economics, from Spain originally, lived in California, and then now loves Texas and lives in Houston. So thank you so much. And so we'll allow for about 40 minutes or so, 45 minutes of presentation, and then Q&A. So I guess we'll let Itziar go through the presentation. Try to hold your questions, unless something is really itching at you. Try to hold your questions till the end, and then we'll go from there. All right, thank you, Itziar.
Thank you.
Okay.
All right, I'm the driver, by the way.
Yes.
So.
All right, so I want to go ahead and get started with the economy. So, as we all know, we're constantly talking about inflation. Okay, so I'm going to try and remember to do this for every slide, because I look at these slides ad nauseum, but I recognize that most of you guys don't. Okay, so the blue line is wages, the orange line is CPI. So right now we're living a 30 to 40 decade high of inflation. So it's at 8%, and it's stuck there. This is pinching the U.S. consumer significantly. I'm feeling it myself in the supermarket, and it's really just squeezing consumers. Median U.S. wages have gone up, also significantly. Also, the first time, or the strongest level of growth in the past 30 to 40 years, about 6-7%. Unfortunately, it's just not enough to keep up with inflation. So last week, the Federal Reserve, for the first time in more than 3 years, they raised the rates by 0.25. So now it stands at about 0.50. They have said that there's still 6 meetings left through the end of the year, and they're going to probably raise in each meeting a little bit, little by little. So they are being hawkish. Their plans are for the rates to be almost 2% by the end of the year and almost 3% by the end of next year. So we'll see how that plays out, if it helps to tame a little bit this inflation that we're seeing. Next slide. So inflation is affecting both durable and non-durable consumer goods, everything. So we can see here that since the onset of the pandemic, the U.S. economy shifted dramatically from a service-based economy to a goods-based economy. Why? Because people overnight were stuck at home, they were told to stay home, and they could no longer travel, they couldn't go out to eat, they couldn't go to the gym, and so they started spending a lot of time at home, and they said, all right, well, I might as well make it nicer to live here. And so Lowe's and Home Depot, for example, have reaped these benefits tremendously. They continue to see just record levels of demand. Sales are through the roof, and that's where we're at with that. Next slide. So if we dive into demographics for just a minute, Texas just swept everyone out of the water. Over the last decade, we've added 4 million new residents. So just to put this into perspective, this basically means the entire state of Oklahoma moving to Texas. So that's a lot. And if you'll notice, you're going to see a lot of blue lines. Those are all Sunbelt states. You see some gray ones, but you see a lot of blue lines. So people are moving to the Sunbelt for warmer weather, for affordability, for low business costs. But it is worth mentioning that this isn't just some new trend that happened since 2010. This has actually been going on for the last 30 to 40 years. Primarily, affordability driven. Next slide. So if we break it down by metro, we can see that not only did the big Texas four, they rank really high this year over year. This trend persisted last year despite the pandemic and the whole situation. Austin grew its population by more than 2%, Houston by more than 1%, San Antonio also did really well, Dallas. And then, no surprise here, on the right-hand side, we see the usual suspects of people leaving certain metros that are just very, very expensive to live in. San Francisco, Los Angeles, Orange County. So, next slide. So then, if we break this down by job growth, how we've performed over the last year, Texas often tends to be the last one in a recession and the first one out. And this has pretty much been the case here. So the thick black spotted line represents the national average, and we can see that all 4 Texas metros didn't witness as much employment losses as the national average, so we all outperformed. And then if you look towards the very right, you'll notice that 3 of the 4 Texas metros, so San Antonio, Dallas, and Austin, they're all well above their pre-pandemic total employment levels. Only Houston hasn't quite recovered to all of its losses, but we're almost there. We're at 98%, so we're almost there. And we're anticipating for Houston to be there by the summer, probably above pre-pandemic. And in comparison, the national average, we are anticipating this not to occur until the end of the year. So Texas is a strong state for job growth. And now let's touch a little bit about housing. So mortgage rates. Okay, no, so back to this. So the blue line is the mortgage rate, 30-year fixed. The gray line is the home price index. So the housing market, in a surprise to many of us, just turned red hot since the pandemic started, and people started buying homes. Mortgage rates were going down. It was just the perfect storm. By 2021, the mortgage rate was slightly under 3%. And what does this mean for the apartment market? Well, it's, the more expensive these houses are getting, the more people are being priced out of being able to buy a house. So that's keeping people longer in apartments, renting longer. This is particularly the case for millennials, first-time home buyers. It's just getting more and more expensive to buy a house. And in fact, now since the beginning of the year, I looked at rates the other day, and the mortgage rate now is slightly above 4%. So we haven't seen that actually since 2019. And they could continue to increase, keeping people renting longer. So, okay, this is a lot to digest. The blue lines are new supply. The orange, we'll call it yellow, is net absorption, demand, and then the green line is vacancy. So last year clearly was a record year for demand. The U.S., this is a national chart, the U.S. as a whole absorbed more than 715,000 new units. So to put that into perspective, to compare, that is double what it typically absorbs over the last 5 years, so double. Meanwhile, last year there was approximately almost half of that amount was actually delivered to the U.S. So about 370,000 new units. 370,000 new units supply, 715,000 absorption. What did that do to vacancies? They plunged. So they decreased throughout last year by 200 basis points, and now from a pandemic high of 6.7 to about 4.9. Looking ahead, we are anticipating this demand to not be at these record levels, but still to remain pretty strong. And I'll touch on a couple of points here. So there were concerns for a while now that in the U.S. in general, there was just a lot of apartment building going on, and that there was just too much new supply. This has clearly proven that the demand is there. People always need a place to live. So those fears have definitely lessened. Furthermore, over the last decade or so, there has been a shift in the type of construction that we're doing, and so currently what's very, very predominant, something like 75 to 80% of all units under construction are in the cohorts of mid-rises and high-rises. So what does that mean? Well, those take longer to build than the traditional garden communities, about 2 to 3 times longer. So currently, we have a significant pipeline. There's about 600,000 currently under construction. We're expecting something like 400,000 units to be delivered this year, so a little bit more actually than last year. But still, with all of this shift in longer development times, all these properties are going to take longer to hit the market, and the demand is still there. We're anticipating it to still remain there. So that means vacancies should remain well below pre-pandemic highs through the near term. In Texas, for example, we call it the Texas donut. So the mid-rise with the garage in the middle. That's pretty popular lately. Next slide. So breaking down national absorption by a metro level, we can see the clear leader was DFW, absorbing almost 50,000 new units. They in turn delivered about half of that, and also worth mentioning, this was typically double what Dallas typically absorbs on a year. Houston, similar story, almost 40,000 units. We delivered, I think it was like 17,000 last year, so way off the charts in terms of imbalance of supply and demand. Austin did very, very well as well. 20,000, they delivered something like 11,000 new units last year. And Austin is really worth mentioning. The fact that they're even on this list is very impressive because their inventory is significantly smaller than all of these other guys. DFW, Houston, New York, it's way smaller. So that really speaks to the demand in Austin in particular. And then the very last point I'll touch on is we typically think of Charlotte, Phoenix, Nashville as these boom towns where they're just thriving, everyone's moving there, lots of job growth, lots of population growth. But notice how San Antonio is also right around there. It's clearly an emerging market that's gaining a lot of popularity, a lot of attention, and people are also moving to San Antonio. Also for its affordability, sun weather, nice people. Next slide. So this slide shows the change in occupancy throughout last year. Again, a similar theme, we're seeing who are the top winners, Sunbelt markets. Orlando, Austin, Fort Lauderdale, and San Antonio all reported increases of more than 400 bips of occupancy change. That's impressive. We also saw San Francisco, Boston, they also ranked really high. This was more of a result of not so much people moving there, but more universities opening and big tech firms saying, okay, we're going back to the office towards the end of the year of last year. And you can see that all 4 Texas metros ranked above they increased their occupancy change more than the national average, which is, I don't know if you guys can see that. It's supposed to be a spotted black line. 2.1% was the US average. And so the 4 Texas metros did better. Next slide. So top net deliveries. Once again, Dallas leads the nation. Houston ranked really high. Austin, they all added significant deliveries. Developers are just very, very bullish. This story isn't that new though. Specifically for Dallas and Houston, they have added, so over the last decade, Dallas has created 200,000 new apartment units, expanding its inventory base by 34% just in the last decade. And Houston has added about 140,000 new units, expanding its inventory base by about 30%. So it's been growing by quite a bit, all these cities. Austin has expanded, I don't remember how many units they've added, but it's expanded its total base by 40%. So that means that 40% of Austin's apartments are 10 years or younger. So they've got a lot of new supply over there. Next slide. Most units under construction. All right, so this is also telling of where developers are focused, where they're bullish. Once again, most of these are Sunbelt markets. I'll let you just have a minute to look at the markets. Where is the construction going? Well, in Dallas, it's primarily the suburbs, particularly to the north. In Houston, it's a mix of the west and the north, just chasing these strong growth suburbs, Cinco Ranch, the Woodlands, Spring, and also we're seeing a lot of construction in the urban core here, near Town River Oaks, the Heights, downtown. People are chasing that walkability, so that's also a growing trend, and people want to live, and it's densifying. Austin is seeing currently about 40% of its construction is located in downtown, and this is because the stabilized vacancy rate in Austin downtown is now at 4%. So people want to live in downtown Austin, apparently, even if they're paying. My friend that covers the Austin market mentioned, yeah, there's a $1,000 premium in downtown Austin compared to other areas of Austin, which is nuts. So you have to really want to live there. So, and then there's also construction in Austin going in the Texas 130 corridor, close to where Tesla and Amazon is expanding. So we're seeing construction over there as well. Next slide. So breaking it down once again by metros, we can see that it's important to talk obviously about total number of units under construction, but also compare it to its particular inventory base. So Nashville is building a lot. So it's almost 15% of their total inventory. Austin ranks number 2 in the nation for this. It's at 10% of its total inventory. So that's definitely going to apply, whether we like it or not, that will apply some pressure on vacancies, because that is just a lot of new inventory to absorb over the next 4 years or so. Meanwhile, on the right-hand side, Houston ranks pretty disciplined. It's just currently we have about 3% of our total inventory base under construction. 3% is pretty doable. It's not alarming. Next slide. So this is a very good story. Dallas and Houston have consistently, for the last 10 years, year after year, led the nation for new supply. And while this still remains the case, we could start to see this pulling back a little bit in the near term. This chart shows the difference in units under construction from 2020 to 2021. And we can see that Dallas led the nation in terms of the biggest change of decline of units under construction. Houston trailed Dallas, and yet, however, Austin bucked that trend, and Austin was number 2 behind Phoenix in terms of change of more units under construction during this time. In fact, construction starts during 2021 reached a 21-year high. So we haven't seen that many number of projects break ground in Austin since 2000. Next slide. So what does this mean? Well, this slide here shows us the share of available units, and they've been steadily declining all of last year with this insane demand that we've just seen ripple throughout the nation, in many parts of the nation. And yes, we are seeing it tick up a little bit as these deliveries still come to market, but if you'll notice, they're still way below pre-pandemic norms and even the pandemic highs. So the demand remains. People need a place to live, and we're still anticipating some pretty healthy absorption over the next couple of years in these areas, in these big 4. So strong compression of vacancy has led to a very strong rent growth over the last year. So once again, surprise, surprise, to the very left, you can see the clear winners, of the rent growth were Sun Belt areas. So the top 10 of the nation were all areas in the Southwest and the Southeast. So Tampa, Orlando, Vegas, Fort Lauderdale, Phoenix, Jacksonville, Austin, and Raleigh all reported 20% or more rent growth. That is outstanding. Let that really sink in. 20% or more. That's double the national average, which was 11% last year. So they really just knocked it off the charts. We'll notice as well, Dallas and San Antonio, double digits, 15%, 13%. Houston was almost made it at 9.4%. Also very, very strong year for Houston. And even areas like Los Angeles that are very, very expensive, they also managed to grow their rents by almost 7%. So it's been a very strong year for rent growth. Next slide. All of that said, Texas does still remain very, very affordable. If you compare, for example, this is a great chart. If you compare our 4 Texas metros with similar peers, such as, for example, Atlanta, and also Inland Empire. Inland Empire is often considered a budget-friendly option in California. But they're still about $300-400 more expensive than most of the Texas metros. And take a look, even Austin is more affordable than Orlando. So unless you're like a really big Disney fan, Austin is still a pretty good choice. And you'll notice also that DFW, Houston, and San Antonio, they're all below the national average for affordability. So it's clear that it's still pretty affordable to live here. Next slide. So, sales volume. So once again, you'll notice that, of course, all 4 Texas metros ranked in the top 15 markets for multi-sales volume last year. But also you'll notice that a lot of these winners were Sunbelt areas, Phoenix, Orlando, Charlotte. And it's funny that San Antonio made it to the top 15. That really says a lot about how popular this apartment market is becoming. It's an emerging market, but definitely it's on investors' radar. So the secret is out. People want to invest in Texas. We're actually getting a lot of calls lately from Canadian investors and out-of-town investors in general. So it was a strong year for apartments. All right, next slide. And then to sum this up, I'll let you guys just read this. I don't want to read the bullets, but you will notice on the bottom charts, vacancy in Texas, when we compare it to national vacancy, it's always, for a while, it's been above the national average. And this is simply because of just this ongoing supply we've gotten in many metros year after year, year after year. So that's really not a surprise. But you'll notice that gap has actually gotten smaller and smaller. We're still gonna underperform a little bit the national average this year, probably next year as well. But it's nice to see that gap compressing. And then rent growth, Texas last year 2020 did see its rents decline just a little bit, but we more than made up for it in 2021. And in 2022, again, we're gonna once again outperform the nation, is what we're anticipating in our baseline scenario at CoStar. Great. Okay, so now I'm going to talk a little bit about all 4 markets, and I'm going to grab some notes. Okay. So, similar to the national trend, it was a record year for Austin. It ranked 6th in the nation for absorption, beating areas like Orlando and Phoenix that have also seen really good numbers in terms of fundamentals. So this compressed the vacancy rate, which was a welcome thing for landlords, because at 2021 the vacancy rate in Austin was among, if not the highest in the nation. So it compressed vacancies by 400 basis points, so double the national average that we saw during last year. And now vacancies are basically at a record low. Moving forward, looking ahead, we're going to see vacancies will probably tick up a little bit just because of all of this construction that's going on, and but they still should remain near record lows. So we're feeling pretty confident about Austin in general. So rent trends. So we saw rent growth turned slightly negative in Austin during 2020, but its growth has been off the charts over the last year-ish, and double the national average, so 20% compared to about 11%. Where are we seeing this growth? Well, in terms of units, we're seeing it in 2 and 3 bedrooms. So a lot of people just cannot afford to buy these very expensive houses, so they need more space. So they're getting larger units. So that's one area where we're seeing the rent growth. We're also seeing it in submarkets. So a couple of Austin submarkets were among the strongest in the nation for rent growth. Cedar Park, Southwest Austin, and Round Rock. They all reported gains of 25% last year, which was very, very strong. So that's where we're seeing, we're anticipating rents to abate a little bit. There's only so much you can squeeze out of people until everyone's homeless. So they can't keep raising rents as much, but they're still gonna be pretty strong. So that should persist for a while. Next slide. So this is a great slide. So we took this from the BLS, and we took the job numbers, and then we paired it with the rent growth, and you'll notice that there's definitely a correlation with the professional and technical services growth in Austin and rent growth. It's not a perfect correlation, and there are architects and lawyers as well in this group, but it's still a pretty good story. And you'll notice, for example, in 2015, there was a dip, a little bit of that, 12% growth to, 5%, which is still wonderful. But we saw that grow a little bit less, the professional and technical services, and then shortly after a couple of quarters later, the rent growth also decelerated a little bit, and now we're seeing both really just soar. So this is a result of giants moving and expanding, and headquarters as well changing to Austin. A lot of them are friends at Silicon Valley. So Tesla, Oracle, Apple, Facebook, they're all expanding in Austin. Yes?
Sorry, what is the time period at the bottom?
Oh yeah, so it's from 2001 to 2022. So, I forgot to mention, so rent growth, the orange line, blue is the professional and technical service. Okay, next slide. So this chart speaks for itself. Austin had by far, out of all of the metros in the country, the most office using jobs growth last year. So let that really sink in. Okay, now I want to talk about trades a little bit. So people are getting priced out. It's a really hot housing market for houses, for apartments. It's just getting expensive. But I did want to cheer everyone up. And I found a couple of examples for all these metros. So this is a value-add garden community, 298 units. It's called Landmark at Barton Creek. True America bought it from Magnolia Capital for about $84 million, $283,000 per door. It previously sold in 2018 for $51 million, about $172,000 at a door. So this earned them a 21% annualized price gain. So there's still deals there to be made. You just have to find them. Okay, Dallas. So, as we mentioned earlier, the pace of construction has been very high in Dallas for quite some time. That said, for the last 7 quarters, it's been decelerating. And in fact, now construction levels are at the lowest they've been almost since 2015. So, developers are taking a breath and pumping the brakes a little bit. A lot of this is driven by supply chain issues. labor shortages, people getting worried of starting an apartment complex and then not having windows. So they're slowly tapering that pace. Next slide. So similar to Austin as well, record year for demand. About 50,000 units were absorbed last year, and around half of that, something like 25,000 units, were delivered last year. Vacancy rates also have plunged to a record low, and we are anticipating them to remain much lower than historic norms through the near term, driven by strong demand, net migration, strong job growth, and then as well, tailwinds include that level of construction just kind of tapering a little bit through the near term. So where is this rent growth happening? Similar story, 2 and 3 bedrooms are definitely the winners. We saw a lot of luxury units bounce back, but mainly it was kind of a rubber band effect because they saw the steepest losses. We saw this trend play out across the country. A lot of people were leaving and moving to the suburbs. They had kids, they were working from home, they needed an extra room for an office, all of the above. So suburbs have consistently outperformed in general in most of these metros. But the urban core has also now slowly bounced back, just recovering some of those losses. And like we mentioned earlier, Dallas saw about 15% of rent growth last year compared to 11% of the national average. We're still anticipating much stronger than historical rent growth, but definitely it's going to start kind of winding down. We're thinking this year already, but still for the next 2 years or so, it'll be way above historic norms. And then I wanted to touch on this trade as well. This is also a value-add garden community. Nuveen Global Cities acquired it from MIG Real Estate for $95.3 million, $317,000 per door, and it was previously sold in 2015 for $49.4 million, $164,000 a door, earning them a 16% annualized price gain. And again, this is value add built in 2002. So Houston, similar to Dallas, we're seeing the level of units kind of taper down under construction. It's at a low of 20 since 2018 levels. So that's nice. The total number of units under construction. It's been winding down for the last 5 quarters. And similar to Dallas, they're just reporting, a lot of developers are reporting supply chain issues, also coupled with just concerns of oversupply, even though this year clearly has shown us that the demand was there. So this should help fundamentals in the near term. So where is construction going on? Well, it's all over Houston, but it's definitely specifically in the north, in the west, chasing these high growth suburbs, areas like Conroe, the Woodlands. They've just seen really strong population growth over the last decade. And then of course we're seeing a lot of densification in the urban core in Houston. So Houston rents did turn negative during 2020. So Dallas did not, but Austin and Houston did. But then they picked up and they've been doing very well. Not quite as well as the national average, 11%, but still 9% rate of rent growth is just historical for Houston. Also, 2 and 3 bedrooms are the winners. That's where people are preferring to now that we're seeing a lot of hybrid work. So people are shifting, certain lifestyle changes. Next slide. So fundamentals, similar story. We saw record levels of absorption, about 30,000 units. of absorption last year and just about 17,000 of new deliveries. Vacancies in Houston are not at a record low, but they are at a 7-year low. So that's nice. And they should remain low through the near term because just also job growth picking up, people moving to Houston, less construction, that's all making for strong fundamentals in the near term. So this trade is also a value-add garden community built in 1976, and it previously sold in 2017 for $4.6 million at $54,000 a door, and they earned a 73% annualized price gain.
Crazy. That's my deal. Thank you.
Okay.
Just as a time check, we have about 5 minutes.
Oh, perfect. Okay. So wrapping this all up, similar story in San Antonio. Vacancies compressed by 300 basis points, so more than the national average, which was 200 basis points last year. They are at a record low. We're anticipating a really strong still couple of years in San Antonio as it's an emerging market that's definitely gaining popularity among a lot of people that are now deciding to move to San Antonio. Similar story here. Rents here did not turn negative at all, which is very impressive during the heart of the pandemic. They are still increasing. We saw a little bit of flattening last August through the end of the year. That's picked up again. Rent growth last year was 13%, outperforming the national average, which was 11%. We're still anticipating stronger than average, both for San Antonio and national rent growth, but again, it's probably going to start to abate a little bit through the near term. So last year was a record year for San Antonio. I love this chart. $5 billion of multifamily transaction volume last year, so that equates to about 2018, 2019 years combined. So it's definitely on investors' radar. I think I feel particularly very, very bullish on San Antonio. So that was a really good year. Next slide. Okay, and then the final one. So this property, also garden community, also value add, was built in 1978. It was renovated in 2018, and it was previously sold in 2017 for $12 million at $72,000 a door, and they earned a 6.5% annualized price gain. So I thought that was a good story.
I actually invested in that deal.
You did?
Yeah. I know that I'm invested in the current.
Oh, that's wonderful. So there you
He
have
invested
it.
after he sold. Yeah, he's being hired.
Yeah, I'm okay.
So then the final comments to wrap this all up. Next slide. So yeah, the Texas economy has bounced back faster than the U.S. Last one's in, first one's out, as is typically the case. Unprecedented apartment demand throughout the U.S. Texas has definitely been a clear leader in that. The tight single-family market is just another tailwind for apartment demand, and increasing mortgage rates, again, another tailwind. The threat of likely Fed interest rates, yes, we're gonna keep seeing them increase definitely throughout this year, likely next year, just to try and get tame that inflation. And this could place a little bit of pressure on cap rates. And finally, yeah, liquidity abounds throughout the Sun Belt, and Texas apartment development has slowly pulled back, except for Austin. That's it.
You Q&A. So we'll open it for Q&A. Go like 15 minutes or so. Yeah.
Thank you. That was amazing.
Oh, thank you.
Amazing presentation.
Great.
So succinct and tight and clear.
Perfect.
There wasn't any guessing as to what you were trying. It's great.
Perfect.
Well, very well done.
Thank you.
A few questions that I had is for the absorption. I think you said 750,000 units in the U.S.
Yes.
So what created that? Like why? You think home prices went up.
Yeah. We get that question all the time.
Like where did all these people come? Like it wasn't the population didn't really increase, right? In COVID, these people were dying. So like where did all these people come from?
So for a while, people were just scared. They were just losing. A lot of people were losing their jobs, and so they were buckling down with a lot of roommates, with relatives. And then once the economy opened back up, they were like, I can't stand to see you anymore. I gotta go. So that was really it's really that simple.
Got it. No, that's a great explanation.
Yeah.
And then the second one is in Houston. Why do you talk about the migration of had the rent growth, and it's like you see stats of Houston migration has been very strong.
Yes.
Obviously the absorption has been strong, but why haven't we seen? What's odd is why haven't we seen jobs return to pre-pandemic levels or exceed that?
Oh, that's another good question. So a lot of our economy, I'm sure you know, is tied directly to oil and gas. And oil and gas, and we're actually going to see, that's a really good question. So we've seen prices bounce back to the point that we can't even afford gas anymore, but they're very high. But we are thinking that might not translate into the oil and gas energy just having this surge of hiring because of two things. One, the oil and gas industry was already kind of in trouble with investors heading into the pandemic, and so Wall Street had said, you need to start paying back dividends. So they have that going on. They're trying to now pay back investors, and also they have gotten smarter about drilling and needing less employees. So that, I think, is pulling back a little bit the Houston economy as to why we haven't recovered as quickly. They're doing a great job in terms of diversifying, because now we have the TMC3 and we're diversifying for sure. But unfortunately, I think it's something like a third of our economy is tied directly to oil and gas.
I think we also have to point out the political current of the administration. When they torpedoed the pipeline, the Keystone pipeline, there were billions of dollars lost, and that sent a message to the oil industry. This is how the administration feels about you.
Yep.
And do you mind just repeating your comment? They couldn't hear you back there.
Sorry. The question here in the back.
Oh, sorry. Yeah, I think that you have to impute the political situation too, not just the economic reasons why the oil industry has pulled back. It's not as profitable with stripper wells and things, but also when the current administration in Washington torpedoed the Keystone pipeline and had sunk costs of tens of billions of dollars, and it just got cut off, the oil industry got the message that we're not going to go forward with things if the administration is going to cut us off. So I think that's a big aspect too. I think you have to look at.
Yeah, for sure.
You touched on it. I'd like you to drill into it a little deeper.
Yeah.
As interest rates go up, it obviously costs more to now buy an apartment with a higher mortgage rate.
Yes.
That same increase in interest rates is going to drive what might have been would-be home buyers out of the home buying market and into apartments. So one's good, one's bad. Can you kind of talk about how those offset each other and what the outcome might be? How clear is your crystal ball?
Oh, I have a direct line with the future. I don't really understand your question.
So as interest rates go up,
Yeah.
it costs me more to buy an apartment complex, so they've got a higher interest rate on my acquisition of the apartment complex. At the same time, an increase in interest rates in the economy is going to prevent a certain number of people from being able to afford to buy a home,
Yes.
which will then push them to increase the pool of people now renting apartments,
Yes.
which is a good thing.
Yes.
So one's bad, one's good.
Yeah.
Can you help discuss how those interplay and what the end result might be? So I don't know if that's clear. seems obvious that as
Like
interest rates
what's-
go up, it costs more to buy, which is bad.
Yeah,
As interest rates go up, it creates more occupants, which is good.
yeah.
What the impact then is on multifamily pricing?
Yeah, can you talk about, have you looked at
Offsetting dynamic.
the net effect of those two?
Of pricing for multifamily or,
Well, pricing for, it's half of it. Pricing for multifamily is because of interest rates going up. It
Yeah.
costs, well, maybe the acquisition cost is not higher, but my mortgage payment
Of
is higher to
course.
buy it and finance it.
yes,
Conversely, as those same interest rates go up, it's keeping people out of the single-family home purchase and pushing them into being additional apartment renters,
Yeah.
which is good for apartment owners.
yeah.
Can you,
I think that through the near term, that's just going to increase. Personally, I think that mortgage rates are still going to keep going higher, and we're going to see more people stuck out of apartments or out of buying houses. I think it'll just last until again there's probably another bubble until things are again in control and again something stops. But I think we're going to see these increases go for a while. I think. I don't know if that answered your question.
I mean, as you know, apartment investors, just to interject, as apartment investors, I think Ryan and I have discussed at length. We just think that apartment prices are unsustainable. The growth, unsustainable. The growth in apartment prices, especially as rates increase. So there's got to be a trade-off. I mean, as you know, she mentioned bubble. I think that's an apt term. At some point, there needs to be an adjustment in pricing that people are willing to pay for an apartment, given that their debt service is going higher. So I think that's kind of the trade-off that's going to happen.
I saw this in like in the 80s in the my background's primarily office buildings. And in the 80s when the price of oil was just, going through the roof, we're all looking for $100 a barrel of oil. A challenge that real estate investors have is the long term. So there's a demand for more, in that case, office buildings, and today apartments. I'll talk about the 80s. So there's a demand for 5 million square feet of office space in this market. 15 people would all go decide to build 1 million square feet of that 5 million demand, but because it took 2 or 3 years for me to decide to do it, to raise funds, to identify land, to hire an architect, engineer, permit it, build it, and start leasing it, then I look around and 14 other people were doing the same thing, and so we needed 5 million square feet of office space, but we had 15 people each adding 1 million square feet to solve part of that 5 million. It looks kind of similar to what I'm seeing in apartments today, that because of the lag time of getting a deal started,
Yeah.
have we gotten better at being able to identify deals earlier? Because there's a demand today, but like you talked about going to mid-rise and high-rise, well, they're longer-term projects. And
Yes.
so it almost makes that matter worse or more challenging because there are developers that are buying land with these things in their mind and plan, but it's going to be 2 or 3 or 4 years before they actually hit the market.
Yeah.
So if those are all hitting the market 2 or 3 or 4 years from now, that bubble has gotten really big and really vulnerable, I guess. Is there a way to better identify things that are in the works before they actually hit the market? Have we gotten better about identifying projects under construction? Or
I don't think so.
land or
Tracking permits, I mean, CoStar has, deliveries or proposed.
Yeah, we do track all of that by sub-market. We track new deliveries under construction, proposed. So,
I mean, you can track that, but you can't track the demand. I mean, you can't
Yeah.
track future demand.
exactly.
Nobody knew COVID was coming, nobody knew Ukraine and sanctions were gonna be applied. I mean,
Yeah.
there's always something, but I think it just highlights the difficulty in forecasting, to be honest, right?
Yeah.
I think what we learned for apartment investing or just, demand is that, it seems, I think why people, all the food groups and commercial real estate, multifamily has proven itself is that during COVID, people, like you said, they couldn't afford, they lost jobs, so they moved to apartments. If rates go up, people can't afford homes, so they're gonna move to apartments. So, it seems like, independent of the economic conditions, there's still demand for apartments. And if the market's going crazy and people move into, demand growth because of job growth happens, then, people are, need places to live, so they live in apartments. But, You know, so I think that underlying thesis is very much intact for multifamily. I think, just like Ravi said, is that investors, you know, for us to syndicate a deal, we require, you know, it's got to be palatable to the people that we syndicate it to, we sell it to. And so if it doesn't hit, you know, certain metrics on cash or total returns, it's like, because interest rates are too high, then, you know, pricing has to readjust, right? So there is, you know, too much capital chasing too few deals, as they say. But, you know, again, that can't go on forever. The 20% rent growth in Austin, it just, you know, that can't go on forever. But, you know, I think that's why we just stay even pickier in the market right now.
Are you tracking any build-to-rent models? I mean, as far as how much that might affect the supply of either?
I knew this was going to come up. So in Houston, so
That makes it a good question.
It is a good question.
Okay.
Yes, I was
They're
just
getting your cookie?
So build to rent, I just learned this myself the other day. It came out of Phoenix, is where it started. It's trickling down to Dallas. In Houston, I believe there's something like 8,000 units, houses, whatever, 8,000 versus multifamily, it's 650,000. So it's just starting. I think, in CoStar we are tracking it.
But 8,000 compared to 20,000 units under construction in multifamily. So it's not that far off of new construction, and all built to rent is new construction.
That's true. That's
And
very
you're
true.
saying the new construction of apartments are generally 2 and 3 bedrooms.
Yes.
And those are the people that would maybe be new home buyers or new home renters. So
Yes.
I'm just wondering how those metrics are maybe starting to affect each
It's
other.
going to be really interesting to see how it plays out. Yeah, build to rent is for a lot of people that are looking for that extra space, maybe better schools or just things that you can't really get in an apartment complex.
Yeah, you are.
So, yeah, it'll be interesting. But yeah, we're starting to track it, but it's an emerging trend.
I have a question.
Yeah.
Hypothetically speaking, what if the political issue with Ukraine and Russia gets worse to where it leads to a war with involves all the whole global economy? What is the effect that you as CoStar possibly see that could affect us multifamily investors and commercial property investors?
If there's a world war.
Hypothetically speaking, yeah. Like what is the effect?
You must have a model for that.
I can do the crystal ball thing,
Yeah,
but
well-
I mean, what if? I mean, you know, how you know the effect of it, like I don't know if you guys, because there's so many developments going on,
Yeah.
all this escalating in terms of our investments. I mean, what if?
Yeah.
Have you guys ever kind of like?
No, I mean, if you ask me, if there's a world war, people aren't going to be paying their rent. So I think there would be a lot of foreclosures and people just defaulting on loans. And
More simply than that, when were those forecasts made? Did they consider sanctions or anything that are?
oh, these? No, they didn't actually. No. That's a good question. No.
I think her question kind of led into mine, actually. It's a two-part. What is the effect on the economy of the eviction moratorium that the owners were suffering, and the foreclosures from the owners not being able to, all of the, even the single-family investors who had renters who refused to pay.
Yeah.
And apartments who refused to pay rent or couldn't pay rent.
Yeah.
And then refused because like getting free money but not being forced to pay rent.
So I really don't.
There's a lot of people taking advantage of it. And,
No.
Yeah, I mean, I can speak to
Yeah,
what we've
sure.
seen at our property. So we own a property in San Antonio and 2 in Houston. And so the eviction moratoriums, they were in place through October 31st. And so you couldn't, no matter what, you know, it was like, hey, please pay rent, pretty please pay rent.
How long, 2 years?
Yeah, so it was a long time, and it was, you know, it was tough. There was rent relief, and so we'd get like huge checks in, you know, like sometimes $10,000 from back rent, because people hadn't paid in a year. And these things would come in and it would just be, you know, a massive influx of collections, but it'd be very spotty. And so like yesterday we got a $4,000 check from a resident, and that's like 4 months of rent for that person. So we've tried to work with them and say like, you have to pay something. But we've had, you know, right now it's easier to get an eviction. The courts aren't as backed up, so we've filed on like 10 residents. And then this way, what we hope now, the strategy is that you file on someone because they've just gamed the system for, you know, a year and a half, and now they know that you have teeth and you can, you know, evict them. So they start coming in and paying, and the neighbors hear about it, and they all start saying, hey, I'm actually, you know, going to go to work and start paying my rent. So
They're giving them some time.
Yeah.
I don't know how many months they have to catch up, but the owners were given some relief, I guess.
it
by the
was,
government.
so, and what's interesting there's Texas Rent Relief, TRR as we call it, and it basically, it was, you know, you go in, your resident subscribes, like the request, they have to provide different documents that, you know, they were harmed from, you know, their employer, they were let go, whatever it was, or they tried to work or couldn't work. And so we would invite residents to come into the leasing office, sit with our leasing manager, and apply for those, because it was huge dollar amounts. And then, you know, to incentivize the staff, we had different delinquency competitions, like whoever could get delinquency down by the most, we gave, you know, cash bonuses, we gave, you know, food prizes. And then recently we also added, like, here are 3 highest balances at one of our properties. It's like, we're gonna pay you, you know, $300 for each balance that you bring in. So, you know, to them that's pretty material, and so we've in a way had to incentivize those people to work and focus on, this is important to us as owners, so, you know, let's make it important to you. And so, but it's been challenging. But what we've also found is that you have a unit that's been occupied by somebody that's not paying, and then you get them out, and then you can lease that same unit. Like one of our properties, we did some renovations to it. We put in quartz and stainless and so forth. We got a $500 rent increase, which is insane. That's like a 50% rent increase versus what we had. So it's tough, right? You have this kind of dead weight, and then you get them out, and then you can turn the unit and rent it higher. Because, you know, everything that you said is absolutely true. It's like, you know, 10-20% rent growth is what we've seen for, you know, returning units. But first you have to get these people out, which just takes time.
You don't want to upset them and destroy your property.
Well, they
You're on the way out.
isn't it they also ask for you to pay them to leave? Like, I was asked $25,000 and they would move
Yeah,
out.
yeah.
It's like.
But now it's like you can get an eviction, so it's like, no, we're not paying you, you pay us.
Stand in line.
Back then, it wasn't last year.
They call it cash for keys, so we try to offer them, you know, we won't hold this against your credit, just leave type of thing.
So it's just.
But it's
just
taken, you know, like our calls with our property, I mean, they've ranged every week anywhere from 1 to 4 hours, depending on how you know, in depth we need to go on things. But, you know, the majority of the time over the past year has been name by name delinquency. It's been such an issue of, you know, this person, you know, where are we in, you know, TRR or other rent relief, and what's next.
And there's a lot of charity resources
Yes.
available for people who want.
Yeah.
So I saw that San Antonio was pretty close to the national average for the 1-bedroom rent increase. And Houston was a little bit negative. Now, if you move that to 2-bedroom, is that still the same between San Antonio and Houston, or Houston is a little bit better than San Antonio when it comes to 2-bedroom rent increase?
That's a really good question. I would have to check. I don't know off the top of my head.
But then from the investment standpoint,
Yeah.
1-bedrooms are going to be less likely, I mean, just the volume of units
Yes.
are less on 1-bedroom, but 2-bedrooms are high.
Yes.
So that could be an interesting, you know, way to look at it.
Yeah.
If San Antonio is a better market to getting investment right now
Yeah.
versus Houston,
Yeah.
because 1-bedroom may not be the right metrics to do that.
Yeah. Yeah. No, that's a very fair point. Yeah.
So we've seen so much cap rate compression in the past few months, and we know this can't keep going forever, right? In the past, there was some correlation between cap rates and interest rates.
Yes.
In future, now people are saying that is not necessarily going to be true. There might be a break in that. correlation? Where do you see this heading in future?
I would be really surprised. There's probably people more sophisticated to speak on this in this room, but I would be surprised if there wasn't some type of a correlation.
Yeah, no, I 100% agree with you. You know, we were looking at a deal and the debt service coverage ratio was actually negative because interest rates were so high, right? And it's like the cap rate can't be that low. Like the deal just does not make sense. You can't have, you know, DSCR or you step in a deal unless there's a great turnaround story. So, you know, either the pricing has to come down or, yeah, I mean, in case, because it's hard to control rates, but, you know, you could just offer less for a property.
I can just see some short-term dislocation to the extent that somebody believes the quality of cash flows from multifamily property is better than the quality of cash flow available elsewhere, given the relative value world we live in. But it cannot sustain itself over the long term. It just doesn't make sense. So, yeah.
The cash flow, you know, at some point, like a 10-year at, you know, 230, 240, it's like, you know, like that's 100% guarantee, right? So a multifamily deal, it's pro forma. So it's just someone's best guess as to what the returns are going to be.
Yeah.
As inflation increases, and I think it's going to increase rapidly over the next few years, you mentioned it'll become a bigger factor of the profitability projects that we're involved with. You mentioned the Federal Reserve anticipates bumping it up to 3% next year, but they're typically behind the power curve when they're battling rapidly rising inflation. Do you or does your organization have a sense for where inflation will really be going in the near future?
You know, I think we do forecast that. I could get that for you. We do have those numbers, yeah.
You know, one of your slides on the graph on the Texas remains effective.
Affordable,
It says
yeah.
affordable. It says Inland Empire. I don't know if you mentioned what is an Inland Empire, because that was like the highest. I wasn't trying to pick that up.
Inland Empire in California.
Yeah.
Okay.
It's Inland Empire.
No, it's an Inland Empire.
It's a part of California, so it's just considered apparently cheaper than other parts like San Francisco. It's just like a cheaper alternative. And the story we were trying to make with that was that even one of the cheaper areas of California is still way more expensive than here.
Oh, you're kidding.
That was
That's
just
California.
Yeah.
That's an Inland Empire.
Yeah.
It's the area of Riverside County and Riverside, you know.
Yes.
Really?
All right.
That's new to me.
Everyone, in respect of everybody's time, we'll cut it off here. But the space is available to us if you want to mingle. You have some extra time to mingle. Anybody has Q&A for her, please approach directly. Free food from us, but Save Waterco. I've got some free pens if anybody wants pens right there. I just want to make sure that's that.
Signing those deals.
Yeah, exactly.
Itziar, thank you so much. Really appreciate it. So next month we'll be back, April 14th.
I forgot the most important thing.